What up, investors? It's July 9th. Whoa, mic's coming in pretty hot. Sorry. And this is, of course, video log takes 30,000 to a million. Walking backwards today, $500. But I'll review the entire account, do the performance, the investing tab. I'll walk through every single position. And what I want to talk about today is big versus large portfolios, all right, or accounts, and some of the benefits and drawbacks, and whether I recommend one or the other or not. So without any further ado, let's go into the account. I'm sitting at, that's Apple, that's not the account. I don't have $146 in the account. 184 280, which is about $500 less than I had yesterday. It's not optimal, but it's about in line with what the market did with S&P 500. I think the NASDAQ was actually positive. Not entirely sure about that. These are the options positions on the right. I'm going to scroll through them really quickly, so you can pause the video player in a moment to try to figure out the exact position. All the information you might need is within this little box right here, including the daily change on the right in percentage terms and in dollar terms. This is me scrolling. All right, now these are the equity positions. Apple is up 0.3%, Realty Income 0.5%, Mainstream 1.5%, Goldman Sachs, Paramount negative, Smith & Wesson negative, DD negative. So the ADRs pulled back quite a bit here, or some of them. Alibaba looks like it stayed fairly flat, but the leaps that I own went negative 4.45%, so that didn't help the account much. So, what are you going to do? Okay, let's do the performance by week. I had a fairly good week, 6.48%. Let's see what the S&P did in last week. So I'm using SPY, which is a ETF that tracks the S&P 500. ETF means Exchange Traded Fund. For those of you not familiar. Okay, so 3.442, so almost doubled the market in the last week. That's good. Let's see, 1 month 5.58, and I did minus 1.64. Okay, so beating the market in the 1 month. 3 month, I'm up 3.27. That's not bad for 3 months. Let's see, on the 3 month, the S&P did minus 12.48. Painful. I didn't know the market's still down this much. It was a pretty good week. Okay, in the 1 year, it's 10.14, and I'm doing plus 8.97. So killing the market. Love to see that. So that's what really motivates me, is like I would really want to beat the S&P 500. It's very difficult to do as an investor. If you do it, you're going to be in the top 90th percentile, which means the top 10 of all investors, professionals, and retail. That's how many people beat the S&P 500 each year. So percentages go down even further and further if you beat the S&P consecutively in a number of years. So only like less than like 0.1% of investors beat the S&P 500 like 20 years in a row or something. Some ridiculously small number, so it's almost impossible. All right. Now, next is the investing tab. Oh, the all-time chart. Okay, fine. I'll show you the all-time chart. There it is. August 28th is when I started investing in 2018. So from right here. It's about 150%. Okay, investing tab. I started investing with this account, I should clarify. I've been investing before that for like 10 years. Okay, total return by stocks by total return. Number 1, 22,000. Total equity, 121, 844. So Apple's growing as a percentage of my account again. Let's take a look at the margin. So I'm still at around $101,000 margin, and I'm sitting a little bit less of a margin percentage, about the same as yesterday, 71% or something like that. Okay, so you double this number because, at 50%, half of the money is borrowed, so you got to double that number. Maybe they should reflect it in a different way. Anyway, let's chill. I was going to do a video about looking at options contracts because I actually couldn't find any, decent contracts today. I looked because I have all this cash, right, that I can margin out, but there just wasn't many good deals. And that's actually a bullish sign because if I have cash that I can borrow, I'll look for puts that I can sell. And if there aren't any puts that I can sell, then I'll just defer. I'll just not do anything. I've been trying to reduce the margin a little bit anyways, and if there are no really good deals that I can take, then I'll just sit and continue to reduce. But that is a good sign. That means that, it's a good sign for the overall direction of the market. So next week will probably be a positive week too. But don't quote me on it if it turns negative. Okay. So today I want to talk about large versus small accounts and some of the drawbacks and benefits of each. I don't have a prepared list or anything like that, but the few major things that I want to go over is like, number one, there isn't a right answer. But there's kind of a right answer depending on portfolio size. So like, for example, if you're looking to become extremely rich and wealthy, and you're willing to take a lot of risk, then you will have a very concentrated portfolio. What are some of the people that did that? Well, for starters, everybody. Everybody, probably including even Warren Buffett. So if you think about every single wealthy person out there, they made a huge bet on one company, perhaps theirs, and that is kind of what brought them to having that status of being one of the world's top most wealthy people. I mean, if you look at, let's say, Jeff Bezos, right? You got Amazon. He just has one really big bet. That's it, You look at Bill Gates. He's got Microsoft. And that's what made him extremely wealthy. Nowadays, his account is a little bit more diversified, but that's a point that I'll mention later. Take anybody else. Elon Musk, right? He's got one big company, really. Tesla, that made him such a huge billionaire. But you can name anybody. Warren Buffett, too. Like, he's got a portfolio of companies, but really what made him wealthy is like Geico. Okay, so he bought Geico really cheap, and then he happened to be a great investor, and of course he did really well with a lot of his other picks, but or he had a few great picks, but really he was pretty concentrated at some points. I don't know the exact history of Warren Buffett, so don't, like, if I get something wrong, like, you can help me out with information, but Ortega, he's one company, I think is like telecom or something. Like all these guys, like Koch brothers, right? They just have one big company, and the Walton family, same thing with Walmart, right? So they just make big bets on their own company or somebody else's company, and that's what makes them wealthy. So if you want to be wealthy, you're going to have to take a lot of risk, which means that you have to have a more concentrated portfolio. So just a few names, or just even just one name, can do that for you. The risk, of course, is multiplied just as greatly. If you only hold one or two names, you could be wrong. And in fact, the chances of you being wrong are very high. So of only only a small portion of stocks look like what Apple looks like in a long-term basis, or what Walmart or Amazon or Tesla look like, on a long-term basis. We're talking 20, 30 years plus. Well, except Tesla's a new company, but you get what I mean. Stop it. And so the risk is actually very, very high. Nobody talks about all these companies that, people that own these companies, that own companies, and they fail, right? Like, for example, the Carvana guys. Maybe I should pull up the chart because the company's still alive here. Carvana, these guys owned a lot of shares of this. Like, they had their entire life savings into this company, right? And it went up to 349, the stock price, which would put it at around, I'm just going to eyeball it. It says 25 right now, 360, so like 95. Which would put it like, I don't know, 60-70 billion dollar company. Right now it's 4.74. So this price dropped like by 95%, right? And they had like all their capital tied into it. So they were really, really, really rich for a moment, and now they're really, really, really poor. So, this kind of stuff happens more often than not. Not everybody is like Bezos and Elon and Warren and Bill, okay? So you got to keep that in mind. So this is, benefits, drawbacks. If you want to have a more steady climb or to be a little bit safer on the downside, then you want to spread out your picks, right? The more diversification you have, the more the chances are that only one or two companies is going to fail, blow up, and the rest of them will continue and pick up the pieces, okay? So it brings a certain amount of safety the more names you have. But that means that you're just going to be moving more and more like the market, right? So if you want so much safety that you want to pick the top, let's say, profitable 500 companies in the United States, based on the United States, then you just buy the S&P 500. That's why people do it. There's no risk. Maybe you gain a 7-8% annual of arguably, real gains. And that's it. If you want something even more concentrated, you can just trade the Dow. Or if you want the top 100, techie companies in the United States, you trade the NASDAQ or whatever. So you can just go by the index. You can create your own index if you want. But I bet you it's going to be pretty correlated with the big indexes already. Like if you pick 20, 30, 50 names of companies that you like, they're probably going to track the S&P 500. Like, you're not going to make the chance of you picking the top 50 companies of the S&P 500 are very, very, very slim. Like, we think we can do it, but chances are that you won't. I mean, chances are 25% of 25 of your 50 companies are going to underperform and 25 are going to overperform the S&P 500. You probably net zero. So you should try to be a little bit more concentrated if you want to either have a chance to beat or to basically, you got to make your account a little more volatile if you want to have the chance to outperform. That's what I'm trying to say. Okay, so big, small accounts, like for example, if you look at Ray Dalio's account, right, or the funds he runs, they're very, very diversified. And yes, he makes macro calls and he's good at that and whatnot, but the chances of him losing wealth for his clients are not very big. He may not gain any wealth, but he's not going to lose their wealth either. So he now has transitioned into, wealth preservation mode for his clients, basically, and he's lucky to gain. Sorry, my computer's making a noise. He's looking to gain 1 or 2% in his fund for his clients per year. And that's good because, 1 or 2% of $1 trillion, or I don't know how much he manages, but that's that's billions of dollars per year. Okay. So, if you eliminate the risk, you're still able to gain a few percent. That's huge. Okay, that's why a lot of wealthy people, especially older people who don't have the tolerance for risk, they buy a lot of bonds because the bonds, yield now the 30s, yield like 3-5% or something like that, larger numbers. So they just wanna, clip coupons. They want to collect that paycheck, and then keep the principal so they can re-roll it and buy some more bonds later. So they want that like super risk reduction lifestyle. But anyways, that's my point about small and large accounts. This is not a recommendation to do one or the other. Everybody got to find their own risk tolerance. Maybe you can even play with the amounts that you put in each stock. You can do kind of like a weighted portfolio where you put 20% in one stock, then 10% in another, 5% in another, and 2% in the rest. Like, everybody's different. You can structure it however you want. But I'm just telling you that the less names you have, the more risky your account becomes. All right, that's it for now. Enjoy your weekends. I'm gonna do some probably company videos tomorrow or the next day. Let me know if there's a company you want me to cover. I'll give you my spin and we'll go through the numbers together. Okay. All right. Peace out.